The money in your bank isn't actually there. This is not a lie and definitely not a conspiracy. This is the unshakable truth of the modern financial system. If everyone went to the bank tomorrow to withdraw their money, the system would collapse within a few hours. Because that money is not in those steel vaults of the banks. And this is not an error, the system is designed this way. This system is known as fractional reserve banking. Today, it is the invisible order behind debt, inflation, and the feeling of wealth written on paper. To understand this system, we now need to go back to a time when digital applications didn't exist. The trick that started in the golden age of money. In the Middle Ages, money was gold and silver, sometimes even animals. Wealth meant metal sitting in a chest. Carrying gold was dangerous, there were many bandits, and there was a risk of death. So people entrusted their gold to jewelers they considered trustworthy. The jeweler gave them a piece of paper. If you bring this note, I will deliver your gold. Soon these papers themselves began to gain value like gold. They were light, easy to carry, and everyone accepted them. And jewelers noticed something very critical. No one was coming to ask for their gold back all at once. Most of the gold in the vault was sitting untouched for long periods. This is where the trick began to be born. Jewelers started writing more receipts even though they didn't have that much gold in their vaults. In other words, they were lending gold that didn't exist and collecting interest from everyone. This became the foundation of modern banking when states stepped onto the stage. Over time, this method evolved into banks. In 1694, the Bank of England was established, not for the public, but to finance the government's war debts. The bank kept lending the government much more money than it actually had. The government repaid the debt with taxes collected from the public. This is why it sounds familiar now. Modern states all still use the same system. It wasn't any different in America. Early banks printed more banknotes than there was gold. When people asked for their money, banks collapsed or went bankrupt. Instead of abandoning the system, they did the opposite. Central banks were established, and this illusion was legitimized. How is money created in today's world? In past eras, banks had to keep a certain portion of deposited money in their vaults. For example, with a 10% reserve ratio, if you deposited $100, the bank would keep only 10 and loan out 90. But this system is no longer valid. Since 2020 in the United States, the reserve requirement has been at 0%. This means banks are not required to keep anything in the vault to back the deposited money. So, what exactly happens when a bank gives a loan? It does not give out the money in the vault, it simply writes numbers into your account. This number is money newly added to the system at that moment. Money enters the system as debt. And the majority, over 90% of the money circulating today is digital money created by banks in this way. So, what controls the banks? In the past, reserve ratios controlled them. Today, the real control mechanism is the Basel Rules. Basel is a council of global standards prepared by central bankers and regulators meeting in Switzerland. When banks issue loans, they must ask the fundamental question, do I have enough capital for this risk? For example, if a bank wants to give a customer 100 units of risky credit, it may have to keep 8 units as its own capital. They are also responsible for holding enough liquid assets to withstand short-term crises. So today, the limits of banks are not the cash in the vault, but their capital and liquidity. The natural consequences of this system. This design makes 3 things inevitable. Inflation, because money constantly grows through credit. More credit, more money, the money loses value. Endless debts. Since money is born as debt, if everyone repaid their debt at once, the money supply would collapse. The system survives through debt. Concentration of power. Banks earn interest from money that doesn't exist. Governments wage war and spend money that doesn't exist. Those with assets gain, salaried workers lose. Crises are the cracking of this illusion. 1929, Great Depression. 2008 mortgage crisis. In reality, both were based on the same root, excessive trust in money that did not truly exist. When the system came to the point of collapse, what did governments do? They printed trillions of dollars and kept the system alive. Because modern economies can never function without this illusion. What is real wealth? Not the numbers in the bank, not a couple of digits. Real wealth is land, skill, production, knowledge, assets, freedom. The system wants you to borrow, consume, and run. It whispers, be a slave so we can live comfortably. But when you understand this order, you stop being a pawn in the game. Money is, most of the time, simply a promise. When trust disappears, it evaporates and vanishes. Understanding the system is the first fundamental step to protecting yourself. If you ignore it, the system uses you and enslaves you. If you become aware, you take control. History has told the same story over and over again. Money is more of a promise than something that truly exists. And this promise evaporates the moment trust disappears. Understanding this order is protecting yourself. If this perspective is new to you, subscribe. Because history has already written the answers. I'm showing you where to look.